One of our other top stories on the pulse, China's Premier Wen Jiabao opening the annual National People's Congress, the meeting that really drives policy for the world's most populous nation. The big pledge: cut spending, restrain inflation, reduce the budget deficit. Wen says China must be ready to combat any financial breakdown, whether it's at home or abroad.
We will strengthen and improve financial oversight and establish a sound early warning system and a risk response mechanism to prevent systematic financial risks.
So Wen Jiabao may have singled out inflation for special attention, but some investors are equally concerned about the risk of deflation. Erik Britton of Fathom Financial Consulting says China needs a revolution in living standards. He argues that if consumers can't drive domestic demand, China's excess capacity could actually trigger a decade-long deflationary spiral. I'm pleased to say that he joins me now so we can ask him about these views, these very interesting comments. I want to start by asking you about your comments, China having a massive growth problem. I mean, I guess that would surprise a lot of people, given that they have enjoyed double-digit growth.
Double-digit growth in the face of teeth of a global recession and collapse of world trade and all that kind of thing. On the face of it, a very strong performance. But the problem is, how did they do that? And they did that by allocating half of their output to new investment. And what that does is it grows the productive capacity of the economy. What they're betting on is that they can find a market for ever-increasing amounts of manufactured products, essentially, but other products too, in the long term. Where's that market going to be? It's not going to be in the West. We're deleveraging. We're not borrowing anymore. We're savers now. That market, if it exists at all, has to be in China itself.
This is in the long term, though. I mean, well, at present, the West is still consuming.
Sure, it is, but we're running down the US savings ratio, personal sector savings ratio, in positive territory. It's going north from there. The same is true in the UK. The world where China could rely on net exports to advanced economies to be its principal locomotive of growth, that world has come to an end. It's got to look to domestic demand from now on.
So this is a long-term challenge for China, but according to Wen, the more immediate problem right now is inflation, which could get much worse as food prices and house prices together continue to climb.
Well, that's true, and the right response to inflation is a monetary tightening. The trouble is he's in a box because normally when you tighten interest rates, what that generates is a higher value for your exchange rate. It's just he doesn't want to allow his exchange rate to appreciate. He wants to keep his exchange rate very weak, very cheap, and tighten monetary policy, keep out inflation even so. And that's a very difficult...
What does that mean for the rest of the world, particularly the US?
It means, in the short run, it means the inflationary stimulus that's coming from the global economy maybe will be reduced. In the long term, though, it aggravates the risk that what we're going to see 5 to 10 years hence is deflation, is outright deflation.
And I love this phrase, there needs to be a revolution in living standards. Are they doing enough to adjust, shall we say, the distribution of wealth in the country?
Nowhere near enough. So Chinese consumers need to spend more than they're earning in income. Their growth in their spending needs to exceed their growth in income for the next 15 years by a large amount. And what that means is they've got to run down their savings. You've got to allow them to do that. And what that means is they need financial services, the kind of financial services that we have in the UK and the US, products like health insurance, life insurance, all those sort of things, which mean that at the moment they save a very high proportion of their income in China, 30%.
Do you realistically envisage a situation where the West can actually export these kinds of financial services to China? Do you think it could happen?
I think it could. I think the chances of it happening are small, but I think it could. If it did happen, I think that's the right way for the global economy to evolve. All the imbalances that have been in place resolve themselves, and I become a global bull. There'd be a massive bull run on equity markets, and a justified one that's justified.
There has been a lot of bullishness on Chinese markets, so hasn't there?
Absolutely there has, and it's because they posted this strong growth during the recession. But the trouble is that there's the seeds of a much longer running negative story in that short run strong growth.
But isn't optimism about China having a more consumer-driven growth model part of that bullishness?
Yeah, but it's just what we feel is they haven't got the urgency of it, the magnitude of it, right? So consumer spending, average Chinese consumer spends $1,500 a year at the moment. That needs to go to $7,000, $8,000 a year in real terms over the next decade. to 15 years. It's an absolutely massive change in the standard of living of the typical Chinese consumer, something no country has ever achieved, really. I hope that they can achieve it. If they do, everything comes good. If they don't, we've got a big problem. Globally, we've got a problem.
Erik Britton, Fathom Financial Consulting. Great to chat to you.
Sure.
Thank you.
Thanks.